Oh, flip, how's it going, guys? I'll be right back, just hold on a second. I'm so sorry about that, guys, but wouldn't you also like to have your Mauritian hat, your ukulele, and your floral shirt all be paid for with the money that you can save on taxes? Well, this video includes a few ways that you can save on paying taxes, but legally. Now, this intro has been a bit long, so just like our taxes, we are going to cut this thing legally and quickly and get straight into this video. So the first method is going to be using the tax thresholds. So if you are under 65, because of the primary rebate that you will get, you can earn 83,100 Rand before you actually have to pay taxes, because the 83,100 Rand will be taxed at 18%, but then you will also be getting your primary rebate, meaning that you will actually end up paying zero taxes. This applies for when you are under 65. The same goes for when you are over 65. There will also be a tax threshold between 65 and 75, and this tax threshold will be 128,650 Rand. Meaning if you earn anything under 128,650 Rand and you are between the ages of 65 and 75, you will pay no tax. And the same goes for being 75 years or older, where you will now get a primary, secondary and tertiary rebate, where you can earn 143,850 Rand without having to pay taxes. This is just a simple method and the most obvious one, and further on in the video we will get more into detail to other methods. Firstly, I just want to say that all of the rates that I used in this video will all be applicable to the 2021 tax period. And so if you are watching this video in a year or 2 years time or anything in the future that doesn't pertain to the 2021 tax year, then the values will be different and the concepts also may change further on in the future. If you earn anything more than 205,900 Rand, that will put you in the second tier of the tax rate table, and that means you will be paying at least 26% on your taxable income. An interest exemption from a South African source would be 23,800 Rand exemption. Unless you are older than 65, then that interest exemption goes up to 34,500. So if you are earning a lot of money in interest and you are worried that you are going to earn above that exemption, then what could be a very smart idea would be to, instead of putting your money into an interest-bearing account, rather put that into a share, which gives you a fixed dividend percentage, which would equate to a similar percentage as the interest that you would earn. And with these dividends, you will only be taxed at a rate of 20%, because dividends income is exempt from normal tax and will be subject to a dividends tax of 20%, meaning that you will not be paying 26%, you will only be paying 20%. This also benefits people who are in the maximum marginal tax rate, who would be paying 45%, and now they only would have to pay 20%. You see, work smarter, not harder. So your boy's got the trusty act right here. He will be making sure that all of the figures are correct to the 2021 tax period. Another great way to lessen your taxable income would be through contributing to a retirement fund. Now, contributing to a retirement fund does have certain limitations, where you cannot deduct more than 350,000 Rand in a tax period, and there are other specific limitations which you guys can see more about if you go check Section 11F in the Income Tax Act. But the great thing about this is that you can carry forward the excess to the next tax period if you do get limited. And this means whatever you do contribute to your retirement fund, which you will be receiving back when you retire, you do get this deduction in the current tax period. Method number 4 would be to join a registered medical aid scheme, because these medical aid schemes do allow for you to get a certain deduction per month that you pay for your fees. Now, this deduction would be 319 Rand per month if there's only one person on the scheme. If there are 2 or more people, however, then you get 638 Rand if there are 2 people on the scheme. And for each additional person after the 2 people, therefore meaning 3 people or 4 people or 5, you would get 215 Rand additional deduction per month for each individual. And the great thing about the medical tax credits is that it is after you've calculated your normal tax liability, and it is not going to be before the taxable income calculation, meaning that it actually has an even greater effect than just this 319 Rand per month. Method number 5 will be mainly for employees. This pertains to when you receive a travel allowance or the right of use of a company vehicle. Now, SARS has made it mandatory that you need to keep an accurate logbook, but you must still be aware of the fact that you guys are allowed to either claim the actual costs that you expend on the company car or the travel allowance, or you guys are also allowed to claim the deemed costs for this travel allowance or the right of the use of the company vehicle, meaning that you guys are allowed to choose the one that gives you the greater tax benefit. The next way to save on your normal tax liability would be to invest in a tax-free savings account. Now, the tax-free savings account, just like the contribution to the retirement fund, also has certain limitations, and there are certain repercussions for exceeding these limitations with the tax-free savings account. The first limitation is that you're not allowed to contribute more than 36,000 Rand in the year of assessment for the current 2021 tax period. And the other limitation is you're not allowed to contribute more than 500,000 Rand in your entire lifetime. And the repercussions of this is if you contribute anything more than 36,000 Rand in the current year, or in aggregate over 500,000 Rand in your lifetime, that excess will be taxed at 40%. And that is your normal tax. It's not included in your taxable income, and that means that it has a very severe repercussion because it is also after your rebates, meaning that your rebates cannot assist you in this liability, but your medical tax credits can. You see the system of flow you got going on here. No, it's solid. I won't lie. That's good stuff. For the tax-free investment, this is under section 12T. If you want to go do some more research for that. The next way you can lessen your taxable income is by donating to a registered public benefit organization. And not only does this help you out with your tax liability, but it also does help the public benefit organizations who are trying to raise funds for good causes. This is under section 18A of the Income Tax Act if you want to do some more research. And now my question for you guys, what would a deduction be without its limitations? Of course there's a limitation, and this limitation is going to be at 10% of your taxable income, meaning that if you do donate anything more than 10% of your taxable income, this will be limited in the current year of assessment. But don't stress, because you do get this to be carried forward for the next year. So don't stress about being a good guy and donating as much as you want. So public benefit organizations are really good causes, and they also assist you in lessening your taxable income. The next method is one that is very beneficial but is very complex also, and this involves rollovers of your capital gains and your recoupments. These only occur in specific circumstances, and so you would need to read the Tax Act to make sure that you are applying it correctly. But the sections that are applicable are section 84E of the Income Tax Act and section 65 and section 66 of the 8th schedule of the Income Tax Act. But basically, if you get a capital gain on an asset, then you would apply section 65 and section 66. If you replace this asset, then your capital gain shall be rolled forward. And if you replace the asset, then your recoupment, which would be taxable in the current year if you sell it, would then be rolled forward if you buy a new asset that is a replacement asset. But I can provide more detail on this. So if you guys do want to see a video on the section 65 and section 66 and section 84E, then drop it down in the comments below and I can see the reception for this request. And this will lessen your tax in the current period. Obviously, each individual has their own situation with regard to tax and what they have to pay and their own situations. And so this video is just a general guideline for South African tax residents. And I strongly suggest seeing a tax expert to advise you on your tax planning, who is aware of your local laws and regulations with regard to tax. And the last one, which is probably the most logical one, yet the one that gets the most people, is paying your taxes on time. Come on, people. Yes, you'd actually be surprised at how many people are affected by the late payment penalties or the non-compliant penalties and the admin penalties. A little tip I would like to give you guys is consider paying your taxes 2 or 3 days before they are actually due, just because the interest you would earn by keeping that money in the bank for those 2 or 3 days is negligible in comparison to the amount of money you would have to pay for the late payment penalty and the non-compliance penalties. Never mind going through all of the complexities of applying for an objection. So guys, get everything in line and in order before the due date, just because this will save you guys such a hassle in the future. And guys, honestly, filing for an objection is really complex and really hard and just unnecessary. So don't even think about getting you guys into that boat. Come on, you guys are my subscribers now. I need to keep you guys safe. I really hope they're subscribers. It has been your boy out with another video on the channel, the third one. So please do like, subscribe, and share this with your friends just to help me grow my channel. I really would appreciate it. And honestly guys, if you did enjoy this video, I think go check out the other ones, just because these are the kind of videos that I'll be posting. And I hope you guys do enjoy it. And I shall see you guys in the next one.